The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. I am Radul Mishra and on behalf of Care Ratings welcome you to our industry webinar series. Today we'll be talking on seaports, understanding India's gateway to global trade. Care Ratings sincerely appreciate your time in joining us for this webinar. To take you further in this, may I introduce our speakers for today. We have with us Mr. Amod Khanorkar, Senior Director and Head Ratings at Care Ratings Limited. Our second speaker for today is Mr. Hitesh Avachat. Hitesh is working with Care Ratings as Group Head Ratings. Our third speaker for today is Ashish Nainan. Ashish is working with Care Ratings as a research analyst and is part of our industry research team. We sincerely appreciate your time in joining us for this webinar. To take you further on this, we'd like to inform that discussion is in form of a presentation which is visible on your screen. In case of queries, we'll be having a Q&A session after the presentation gets over. I repeat, speakers will take the Q&A session at the end of the presentation. Request you to please key in your queries in the slot provided. May I request Mr. Amod sir to begin the session?
Good afternoon. Thanks, Mridul. I'm Amod Khanorkar, and after my opening remarks, my colleague Ashish and Hitesh would take you through the detailed presentation. Seaborne trade plays an important role in the Indian economy. It is an efficient and economical means of export and import of heavy merchandise. Growth in trade of a country is an important indicator of its overall growth. Internal trade of the country not only fulfills the requirement of its different regions but also promotes balanced regional growth in the country. Foreign trade, on the other hand, fulfills twin objectives. One, that of providing means for expenditure of surplus items of the country and making available items that are not internally produced, thereby leading to rapid economic progress of country. And therefore, in that context, roles played by the port is extremely important in the overall development of the country. Today's webinar, we touch upon state of the industry, which will be covered by Ashish, and then we go on to look at how we view ports from a credit rating perspective, which shall be covered by me. Subsequently, in the Q&A, it will be me, Ashish, and Hitesh who will touch upon your queries. I'll now hand over to Ashish to take you through the status of industry and the fundamentals of it. Thank you.
Thank you, Amod, and a very good afternoon to all of you. Today, I will be touching upon the fundamentals of the sector, and the port sector holds a very unique significance as a part of the entire industrial ecosystem for the country. When we talk about India, we have some 12 major ports, out of which we have 6 on the western coast and 6 on the eastern coast. Among the non-major ports, we have some 190 non-major ports, which come under various state maritime boards, and out of which around one-third are capable of handling larger vessels with merchandise. Now, if we were to think of the two big factors which highlight the potential or significance of Indian ports in particular in the region, I'd like to highlight that in terms of merchandise trade as a whole, uh, port merchandise constitutes for 27.5% of our GDP. Now, this number is very significant on the backing of a growing large economy like India, which is expected to reach $5 trillion in the next few years to come. The other significant or important factor is more geographical than anything else. So when we talk about the Indian Ocean region, in which most of our coastline lies, 50% of the world trade passes through this IOR, and almost 60% of the oil trade passes through this particular region. Now, how our ports could function, we could say that these could function as hubs from where these vessels could pass over to other nations. Now, if you were to see how cargo handled has been performing vis-a-vis, we have tried to put up a graph in terms of how GDP has been performing and how was the cargo handled by the major and non-major ports in the country. If we talk about the framework of the Indian seaports, we have two bodies who mainly control the major and the non-major ports. If we talk about the major ports, they come under the tariff authority, who is more of a regulatory authority who fix tariffs for the major port trusts, which again comes under the Ministry of Shipping. Now, again, under the major seaport trust, we have major ports which function as public terminals who handle most of the cargo by themselves, as well as they have conducted auctions to various private terminals who take up individual trade cargoes. Under the state government, we could say that we have state maritime boards who have non-major seaports, and we have both state-managed ports as well as private seaports who are functioning at various locations across the country. Now we would touch upon the capacity utilization. So, like I said, we have two categories of ports. So, in major ports, we have some 1,065 million tons of total capacity, out of which in the year 2017, 648 million tons of cargo was handled with a growth rate of 6.5% over the financial year 2016. On the same hand, non-major ports have a capacity of 800 million tons, out of which 485 million tons of cargo was handled in the year 2017 with a growth rate of 4%. Now, in terms of capacity utilization, both the major as well as the non-major ports had a capacity utilization of around 61 to 62% in the previous year. If we talk about the cargo handled, we have tried to come up with a graph showing how the major and non-major ports have performed over the years, starting from financial year 2002 and financial year 2017. And more or less, non-major ports have been growing till around FY17, on which we'll discuss later on during the presentation. Now, in particular, we would be talking about the major ports. So, if we were to look at individual major ports and performance over the last 10 years, in terms of CAGR growth, we could say that Kolkata, Cochin, and Paradeep in the same order have performed quite well in CAGR growth percentage, with Kolkata leading with around 15%, closely followed by Ennore Port, which is at 11%. And on the third place, we have Paradeep Port with around 8.7%. In terms of absolute volumes handled, there is no doubt the top four ports would be Kandla, followed by Paradeep, and then followed by JNPT and Mumbai, which are closely there. For the year 2017-18, we have the numbers out through, and this year Kandla Port has been leading with around 91 million tons handled during the year, followed by Paradeep Port at 84.6 million ton, and followed by JNPT at the third place with 54.5, and Mumbai Port at 52.7. Now, interestingly, out of the four ports, three are in the western coast, Kandla, Mumbai, and JNPT, and Paradeep lies in the eastern coast. Now, we'd like to touch upon the performance of non-major ports. So, like I said earlier during the presentation, that non-major ports, if we take the duration between 2007 and 2017 in particular, so cargo handled by non-major ports has grown at a CAGR of around 10.7%. Now, that is by far exceeding the major ports by a very wide margin, whereas cargo handled by major ports during the same period has grown by around 2.5%. Interestingly, if we talk about the non-major ports, if we talk about the Indian coastline, it is shared by some 9 states and 4 union territories. Out of these 9 states, only 4 states, namely Gujarat, Andhra Pradesh, Maharashtra, and Orissa, account for some 97% of the cargo handled by all non-major ports. And if we talk about the top 2 states, which is Gujarat and Andhra Pradesh, they account for around 85% of the cargo handled by the non-major ports in India. Now we'll touch upon the how nature of cargo has evolved in terms of mainly by the major ports over the years, and the years in question would be FY 2010 and 2017. So it is pretty much evident that petroleum and oil related products have constituted always upwards of 30%. So during there has been not much shift, and when we look at petroleum products, it has been in the range of 31 to 33%. So it was 31% during the year FY 2010, and during 2017 it has been 32.3.7%. The percentage share of containers overall has grown from 18.1% to 19.7%. Coal thermal has grown from 7.7% to 13.7%. Now, this you could relate to the overall increase in the overall thermal capacity addition in the country, which has grown drastically between 2010 and 2017. So same goes for coking coal and iron ore, which are correlated. So these are more or less related to the steel industry. So the percentage of coking coal has increased from 5%, 5.1% in the overall trade volumes related to 7.6 in during the current year, and iron ore has decreased from 17.8% to 6.7%. Now there are some regulatory things which lead to a fall or increase in some of the cargo handle. For example, there was some ban on iron ore mining in few states, which leads to increase or decrease in the particular cargo handled at those state ports. Another thing we could keep in view is the use of domestic coal for thermal coal, which could lead to an increase in decrease in the coal thermal handled during at these major ports. Interestingly, for the POL, we think what would lead POL or what would continue the share of POL in the overall cargo handled would be the increase in refining capacity, which we are expecting in the next 3 to 5 years. So through various sources, we come to know that it's going to be in the range of 40 to 50%. So that would make POL to continue its share of around 33% in the next few years to come. Another interesting area would be containerization. So in absolute numbers, we could say that containers handled during the year in India were around 13.7 million TEUs, whereas the overall capacity is around 21 million TEUs. And almost a large part of it was handled by the major ports themselves. In terms of trade partners for India, the 5 major trade partners are China, USA, UAE, Saudi Arabia, and Hong Kong, and they constitute for almost 50% of the total trade between the two countries. Now, we'd like to touch upon the evolving dynamics of major ports and non-major ports in particular. So, if we are to take the 2 years again in question, the last one decade, 2007 and 2017. Till 2007, non-major ports contributed to almost 71% of the total cargo capacity handled, which has declined to almost 55% by the year FY14. In the same breath, non-major ports handled 29% in the year 2007, and it has increased to 45% during the year 2015. Now we see a reversal of this beginning 2015, wherein we saw major ports capturing back that lost market share to an extent by a percentage or two. And here we are in 2017, wherein major ports are almost back to 57% of the total share in terms of cargo handled, and non-major ports have retreated to around 43%. So now, what has led to this is definitely the government's focus on utilization of more of major ports, improving their efficiency and implementing number of policies which could help major ports to expand their overall market share. Now, while we were talking about efficiency of ports, like I said, the government has been implementing a number of policies. Sagarmala has been one of the main focus areas of the government in terms of development of port level development and creating an ecosystem for businesses around these ports, as well as improving efficiency by bringing in mechanization, automation, new terminal developments, and bringing in a landlord model of operationalization of ports. Now we shortly touch upon the improving efficiency at ports, which we discussed before. So in terms of that, there are few policies which we would like to highlight in particular. The first one being direct port delivery. So at the moment, limited number of ports, that is in particular 2 ports, JNPT, Jawaharlal Nehru Port Trust, and Chennai Port Trust have implemented the direct port delivery. And in the past 1 year, the share of direct port delivery has increased from mid-20s to around 31% at the moment. And this DPD is mainly applicable on containers, and 35% of the total containers handled at JNPT at the moment are under DPD. Now, DPD not just cuts time, but it also helps suppliers and importers in bringing down their cost. The other important efficiency improvement measure has been a decrease in the turnaround time of ports. Now, this could be in relation with the automation methods or different movement of goods inside the port, which was brought under the Sagarmala project. So, major ports have registered an improvement of from 2.61 days earlier to around 2 days currently. Now, definitely there is some scope for development or improvement given the different Sagarmala projects implemented. We can expect our ports to match, if not better, the turnaround time of some of the ports overseas like Rotterdam, Shanghai, and Singapore. The other important part being draft or depth of the berths at ports, which have improved considerably during year. And 10 out of the 12 major ports have a draft of over 14 meter now. Now, this is an important thing in terms of the kind of vessels which can be handled by these ports, which we'll discuss in detail later on. Renewable energy at major ports has been an important efficiency improvement measure at the ports. And finally, landlord model of operation of major ports, which has been gaining traction over the past few years. Moving on to some of the challenges in the sector. So, like we said, there would be numerous, but some of the few or the key highlights from our end would be connectivity with the mainland in terms of highways and railways. Drafts at major ports. So, like I said, 14 meter right now is the standard, but if we look at international ports, it's in the range of 18 to 20 meters. So we still have a great scope for improvement. And automation, tariff and clearances for ease and movement of goods, and regulations and clearances for development of port projects would be something which we would look forward for the ease of the private sector. Now we would hand over the presentation to Amod from here. Thank you.
Thanks, Ashish. Now we quickly come to get onto the topic of how we go about analyzing the seaport. What are the issues that we see as far as seaports are concerned on a business side, on a finance side, and how we go about analyzing and assigning the ratings over there. Uh, and then for that, it becomes important to understand the characteristic of the credit or characteristic of the asset that we are rating. And because from the nature of the asset, from the characteristics or the issues that the asset faces, the risks that are going to be there, they emanate. And a credit rating is nothing else but analyzing all the risks and assessing whether the borrower will have capacity to pay back the monies that have been borrowed today in the future. Um, I'll come to the characteristics of Seaport, and Seaport essentially is an infrastructure asset. It being an infrastructure asset, I'll first touch upon on the issues that we see as far as a typical infrastructure project is concerned. If you take any infrastructure project, be it a port, be it an airport, be it a power plant, be it a road, oil and gas asset, some of the characteristics, some of the issues, some of the properties, they run common through them. And I'll quickly touch upon on that. This will be typically housed in SPVs, a special purpose vehicle or special purpose entities. Um, and that will be especially true if it is a project financed asset. Project financing is essentially or is typically a preferred way of financing an infrastructure asset, and typically is for the purpose of financing of a major independent capital investment without recourse to the sponsor. And that is one of the main reason, and that the sponsor wants to be sort of a bit delinked from the huge capex that is being taken, huge risks that are being assumed for a project which is going to be under construction with a long gestation and there and significantly much longer operational period as well. In the project finance asset, only the cash flows from the project are available for the purpose of servicing of the debt that is availed, which also means that project sponsor is ring fenced from the risks arising, and technically thereby the equity that a sponsor puts in is the only exposure that he has, and the lenders or the capital market money provider should be then analyzing only the asset and then from wherein the servicing uh, of the debt or the bond can be made. So that's briefly on project finance and SPV nature of the infrastructure project. Some of the other characteristics of infra projects would be they are capital intensive, large, huge, significant investments running into millions and billions of dollars. Um, all infrastructure assets typically they will be either monopolies or oligopolies. Uh, and more often than not, there will be sort of a natural monopoly. You look at any of the infrastructure asset, whether a highway, a oil pipeline, a water pipeline, airport, to some extent, electricity distribution, not to some extent, to full extent, electricity distribution, power generation. Each of them has a monopolistic nature in it. Or at best, there could be oligopoly, and there will be no good competition that will be really present. And because there is no good competition present, by default, you will have a regulator in place to act as a proxy for the competition. As the sector evolves, if the competition picks up, the role of the regulator will slowly and steadily come down, which possibly in the Indian context you can see in telecom, where the regulation is light-handed as far as the TRAI is concerned, whereas some of the other sectors like airports or power sector, they continue to be heavily regulated. Airport, for that matter, will be ERA, and power sector will be Electricity Regulatory Commissions. Next characteristics of an infra project will be highly leveraged, and high leverage is acceptable in the financing world as far as infra assets are concerned. High leverage essentially indicates a high amount of financial risk, but the business risk as far as infrastructure projects are concerned is low, for the simple reason that they offer you an essential service, a demand for which will always be there by and large, and the tariffs also will be sort of either regulated, controlled, and will be sort of decided, which thereby ensuring that the amount of inflows that are going to be there, amount of earnings are going to be there, they are going to be stable and predictable. This predictability in the cash flow allows you to assume high leverage, and that's the reason why you will see all infra projects finance 2x, 3x, 4x, 5x, 10x, 20x, 100x, depending on the nature of the asset. We discussed this point. The infra projects typically, if project finance, they will be without a recourse. Without recourse and only single stream of cash flows that is available for the purpose of servicing, and hence there will be a strict control on cash, the way it's going to flow, and then therefore you'll have a waterfall mechanism which will be typically operated by a third party, or typically a trustee or so. SPV nature of the infrastructure asset, that allows you to multiple participants, multiple parties, multiple stakeholders, multiple shareholders. Um, Liquidity in infra assets is low because of the very specific nature of the asset, and the life is limited. At the end of the project, typically the capital will be returned to the owners after meeting some of the predefined norms. Let me now come to the characteristics of the seaports, and that's there in front of you on your screens. Seaport derive their strength from being a provider of a maritime infrastructure. These are capital intensive, point which I made earlier. Typically, in the Indian context, this could be in the region of $1 billion for not billion. It will be about 100 crore rupees per million ton of capacity in terms of the capital outlay. Sorry. Performance of a seaport is closely related to the economic growth and trade. A very strong correlation can be observed between the growth in a GDP, growth in a trade, and the performance of the seaport. The ports, they face limited competition. You will not find too many ports in vicinity of each other. Each of the port will typically thereby cater to a particular geography, and hence would have a limited competition. They generally you'll generally find in the context of operating seaports, you'll generally find customer concentration. Transportation economics, inventory management, outsourcing growth in consumer products have led to increase in containerization. That is one of the trend that we would have seen in the port sector. The way ports are classified, I've tried to put a classification in front of you. The globally seaports are classified on various parameters like size, hinterland size, location, type of cargo handled, ownership of the seaport, etc. As per the United Nations Conference on Trade and Development, UNCTAD, we have four categorization: dedicated hub seaport, hub and a load center seaport, direct call seaport, and a feedered seaport. The dedicated hub seaport, these are the ones which are used solely as a transshipment port. They cater to a very low level of a national cargo. These are the seaports with high level of geographical advantage. And a good examples of this will be Singapore and Dubai ports. On the other hand, hub and a load center seaport, these are similar to dedicated hub seaport. The difference between the two is the former one has a more strategic location, while the latter, which is hub and load center seaport, along with the transshipment cargo, also generates significant hinterland cargo. And the example for this will be Rotterdam and Hong Kong ports. Direct call seaport, they generate their own cargo. These seaports fall on the main line of shipping lines. They may generate transshipment cargo, but the share of transshipment cargo is very less. A good example of this will be JNPT, Mundra, Australian and Chinese seaports. The feedered seaports, they are small in size, who generate low level of cargo, generally consisting own cargo and no transshipment cargo. Underdeveloped nations typically will constitute a large portion of feedered seaports. Coming to how we go about analyzing a port company. Um, in any credit that we do while doing the credit rating, essentially three things we look at. We look at a business risk, we look at financial risk, and we look at management risk. And in the context of infrastructure asset, business risk assumes extremely high importance. Financial risk, as I mentioned earlier, generally will be on high side, simply denoted by the high leverage and high debt that you take. And that high debt essentially is to be serviced out of the business earnings, and thereby it becomes extremely important to be in a position to analyze the business risk of the infrastructure asset. As far as business risk and the parameters therein are concerned, as far as seaport are concerned, we look at the model of operation. What type of port are you? Whether it's a landlord or an operator seaport. A landlord seaport generally has more stable lease revenue as compared to an operator seaport, which are dependent on cargo throughput. A combination also exists where the seaport operates a few terminals and rest is leased out to third party. Landlord seaport, this seaport in addition to rentals operate on a revenue share basis as well, thereby assuming some of the revenue risk. Concentration can be an issue in landlord seaport where large quantum of revenue is from a single operator. Coming to market position, in market position we would look at issues such as size and wherein we'll try to see the capacity of the port to handle the cargo. Sorry, the whether you are a single location port or you are present at a multiple locations in terms of being multiple ports. As far as the location is concerned, location is something which is extremely important from the success of a cargo success of a port point of view. And some of the issues that we will look at over there will be ability to handle the large ships drafts. If the draft is shallow, then dredging and channel cutting will be required, which is a capital expenditure. whether the port is an all-weather port or a limited duration port. In the service area, which is the area which you cater to, if the cargo is local, then the economic prosperity and economic vibrancy becomes important. How that particular region to which it is catering in terms of either in terms of trade, it becomes extremely important. And from that point of view, some of these something like JNPT and so on would obviously which caters to rich and a vibrant western part of the country would score well on this. Sea trade and then GDP have a strong correlations that we sort of touched upon earlier also. Hinterland connectivity, connection to the hinterland is critical for quick distribution of goods. Avoids choking up at seaport premises. So we have seen some of the ports getting into problem because of the bottlenecks in terms of the connectivity in the past. Composition of the traffic, the nature of cargo handle, concentration of cargo dependency, and so on. As Ashish mentioned some time back, we saw a problem of some ports running almost dry because they were dependent on ore exports and because of the regulation which simply stopped. So some of those challenges are always there. In the operational efficiency, we essentially look at operational efficiency from the point of view that if you efficiencies are good, then the cost to produce whatever you're producing is going to be low, or cost of service is going to be low, and thereby by your EBITDA margins are going to be good. And some of the things that we would look at while analyzing a seaport would be seaport mechanization facilities, the level of O&M expenses trend in that, the turnaround time, and so on. See some of those issues. So thereby, some issues, some key ratios that we'll analyze from the business perspective will include growth in operating revenues, EBITDA margins, trend in both of these, working capital management, and ROCE. These are some of the parameters that we would look at from the business point of view. As far as the financial analysis is concerned, it's essentially the ability to serve the debt, and thereby debt to EBITDA is something a crucial number that we would look at. Leverage and coverage, liquidity ratios, debt coverage ratios. Some of these issues are important. Cash flow becomes important in terms of knowing what type of cash generation you have from operations. Financial flexibility, if any, but if it is a project finance asset, we'll believe generally that financial flex will be finflex will be low because there's no other asset sort of to against which you can sort of mobilize monies. We'll run some sensitivities in terms of costs and volumes of the traffic. Interest rate risk is something that we'll essentially look at. If you have foreign currency loans, that foreign currency exposure aspect, because you deal with if the lending is by foreign party, then the analysis will also look at sovereign risk, country credit rating, transferability, and convertibility rating. So these are some of the issues that we'll look on the fin side. Sorry. Let me now come to some of the credit nuances as far as some of the ports are concerned: public port, private, and a captive port. Well, the in terms of our experience, public seaports that we have looked at, the some of the factors that immediately come to mind is a sovereign ownership, which in itself starts giving a leg up to the rating. Some of the ratings that we have, live ratings we have on the seaport, essentially reflect the GOI, that is Government of India ownership, and maybe the credit is equated with the GOI itself. Um uh, as far as the public seaports are concerned, tariff is fixed by regulator on a normative cost-based approach, and therefore, whether you are achieving your normative parameters or not, for full recovery of tariff is something important. Um, this will be typically landlord model that gives you stable rental income, relatively lower handling charges compared to recently established seaports, essentially because of the low depreciation numbers, and regulatory risk will continue to be high as far as the public seaports are concerned. Coming to the private ones, the some of the key issues are they have flexibility in tariff determination. Composition of cargo mix and hinterland connectivity is a key parameter. Uh, High business risk as compared to major seaport. Take or pay arrangement with strong counterparty is an important parameter. Some of these seaports, on the private side, have faced significant cost overrun, resulting in high capital cost and adverse IRRs as far as the project is concerned. If you're analyzing and if you're looking at a captive seaport, then the counterparty's credit risk profile becomes extremely important. Importance of the commodity that is being handled by the seaport for the off-taker, how significant, how important it is, and that will sort of reflect the willingness and ability, more so a willingness of the counterparty to make a payment in a timely manner to the port company. So that will thereby have a bearing as far as credit rating is concerned. As far as care is concerned, we have now live ratings which are outstanding on 14 of a total companies. Unfortunately, I think that's not on the slide there. And the dispersion of ratings, we have two ratings which are in AAA, two in a AA, two are AA SO, and those SOs will be because of some structuring, some credit enhancement, some equations, some guarantees that would have been possibly issued out. We have one credit in A and two ratings which are in D category, essentially indicating that they are currently defaulting. With this, I actually we are I'm through with my part of the presentation. What we do now is this: we split for 2 minutes and then come back for a Q&A session. Thanks a lot.
Hello, good afternoon, everyone. This is Hitesh here. There is a first question from Mr. Sriram from Mint. The question is, what are the primary reasons why non-major ports have gained market share in recent years? Uh, Sriram, if you look at the last decade from FY07 to FY17, yes, definitely non-major ports share has increased from around 20-25% to around 40-43% currently. Now, the primary reasons for this is basically there are a couple of ports which actually came up with a huge capacity, and it went up increasing. Especially the to name a port is like the Mundra port, which is actually showing significant increase in terms of the cargo handled. However, if you look at the last 3 years, wherein the major ports have actually increased upon their capex activity, what you can see is actually the major ports have now started growing at a much faster pace as compared to the non-major ports. So maybe in FY15 the major ports were accounting for around 50-55%, but now they have gained a market share of around 57-58%. So this is actually the reason for disparity is mainly because of the capex cycle which major or non-major ports were going in. Earlier the non-major ports were having a huge capex cycle, and that's the reason they were gaining more. However, now what we can see is even major ports have started implementing their capex activity, and the results are shown as far as the volumes are concerned.
We have the second question from Sriram once again. And how balanced is the EXIM port traffic in India, west versus eastern part of the country? Any trends like east gaining share? Hi Sriram, this is Ashish here. So coming to your question, I think in terms of capacity utilization in east versus west, east lags at a 59% to the installed capacity. So what will be the installed capacity for the eastern region? Eastern region has been utilizing it at 59%, whereas for the western region it has been in the range of 65 to 68%. Now some of the ports, like I mentioned earlier in the presentation itself, that the top four ports, out of which three are from the western region, which is Kandla, Mumbai and JNPT. So it could be more related to the petroleum and other products, as well as container being handled at the higher. So in short, if you were to talk about the container handle total in India, 33% is handled by JNPT alone, which speaks volume. So yes, in terms of absolute share, western region has an edge over eastern region for sure. We have a third question from Ankit. What is the capacity utilization of container handling in India? So the container capacity total installed in India is around 21 million TEUs, or 24 equivalent units, out of which for the previous year it was in the range of 13.7 million TEUs. In the 21 million TEUs, it is evenly distributed between the private sector and the public sector. So if we are to take individually major ports, have a higher capacity utilization of around 75-80%, whereas that for the non-major ports would be in the range of around 55 to 60%.
There is another question from Miss Radhika, and she want to understand what is the overall cost of container imports as far as India or any other country like Singapore is happening. Uh, to answer to your question, I mean these are estimates, or these are the average cost per container per ton basis. So roughly, the Indian ports would be having an average import cost per container at around $1,110 or $1,150 per ton, which is when compared with a port like Singapore, it is around 400 or $450. Now the reason for such disparity is Singapore is basically a transshipment hub, so probably the cargo would not be entering or exiting the facility, and the lead time for that car for the container would be very much lower, and that's the reason why there is a variation. No doubt, the overall infrastructure does play a role, but apart from the infrastructure, the kind of cargo which India actually takes is actually for imports in terms of for consumption purpose, but in countries like Singapore it is more of a return cargo kind of thing. There's another question from Mr. Vishal, and he wants to understand how much is the draft which is required for a Handymax or a Panamax vessel. Vishal, to answer to your question, both Handymax and Panamax vessels, they actually differ in size. So, for a Handymax vessel, which is relatively a smaller size vessel, the average draft required would be somewhere in between 11 to 12 meters, whereas for a Panamax vessel, which is basically a higher size vessel, the draft required would be around 13 to 15 meters. If you look at Indian major ports, the average draft somewhere would be around 14 meters. So Panamax vessels actually can go to any of the major ports. There's one more question from Mr. Vishal, and he's asking for what is the estimated cost of development for a million ton capacity of a port versus for a berth. Vishal, roughly, if you look at for a port, an average million ton capex cost would be somewhere around 100 crore. However, you may not find any port which is coming out with less than a 10 million ton capacity. And if I have to look into the average cost of a berth, so let's say for a berth of around 360 or a 370-meter berth, the average cost would be around 30 to 40 crore. However, this will differ from the kind of cargo which is been for which the activity is taken. So for a iron ore berth of around 370-meter, it may be costing around 25 to 30 crore, whereas for a coal terminal it could be around 40-45 crore. So even for some special POL products, the rates can the capex cost can be even higher.
Hey, there is one more question from this is Amod, and there's a question from Manisha. Question is, will you limit rating of a operational infrastructure SPV which is a single off-taker to the credit rating of the off-taker? Hi, Manisha. Thanks for your question. This your premise is correct. And by and large, if it is an operating asset and there is a single off-taker, generally the credit rating of the off-taker will be a limiting factor, unless there is if the off-taker defaults in payments and there is a way or a way out which is possible to move out of this particular single off-taker and have the sale arrangement with some other party with someone else, then possibly there may be a way to look at rating which is better than the counterparty's rating. Otherwise it will be limited to the counterparty's rating. And I'll give you an example of this. Look at for example, say a power plant. If a power plant is selling to an electricity board and an electricity board has a low rating, and there is a PPA which says that there is no way that the power plant can sell to anybody else, but only to the electricity board, then in such cases the electricity board rating will become a constraining factor for the credit rating of the power plant itself. But uh, if the PPA says that after say a period of 3 months of a continuous default, the power plant can then start selling to outside parties through the network, in which case then the rating of the electricity board will not become a constraining factor, and you possibly can start looking at what other options then the power plant will have. Will it be competitive in the market outside this arrangement, and then look at possibly rating which may be then possibly higher than the off-taker rating. Some small even in a very constrained type of arrangement where you don't have any other option but to sell only to a particular counterparty, some small measures may lead to, not small, some measures may lead possibly to a small improvement in ratings, typically, which will be liquidity reserves and so on and so forth, which will take care of temporary mismatches and so on. But by and large, if there is no way out, no exit, and there's a if you are wedded only to a single counterparty, then that counterparty rating becomes extremely important. And as a corollary of that, as the counterparty rating improves, your rating possibly will start moving up, or the other way around. I hope that clarifies. Thanks a lot. And we, since we don't have any more questions, this will close with this. Thanks a lot to all the participants for the patient hearing. With this, we'll close. Thanks a lot.